Good morning, everybody. Hey, welcome to Tuesday. Man, was yesterday a crazy day on Wall Street? What a drop we saw. I'm sure that's going to be the main focus of Dave's conversation today. But before we get started with Dave, I want to thank you again for joining us. I really appreciate it and hope that you find this valuable. If you do, please like our page on Facebook and share this video with your friends and family. Really would appreciate it. We want to keep this thing going. Hey, I want to again remind you about the free report we have. I think it's pretty important after yesterday's close on market corrections and what do they mean, and understanding how they affect you, especially as you get closer to retirement. To get your free must-have report on market corrections, just text MARKET to 863-285-3815. Hey, here on Facebook, you can look at the post right above this and click the link, and it'll take you right to it. I want to thank you again for joining us. Dave will be with us in just a moment.
5.7 Light FM. Well, you want to make me cry? Look at my stocks. That'll do it.
Markets made you cry, didn't they, Dave?
This time we check in and find out what's going on Wall Street this morning, and we check in with the offices of Statler Financial Services in downtown Sebring. Phillip Statler is standing by. Phillip, how's the whiplash doing this morning, huh?
Hey, man, those markets were making you cry yesterday, weren't they?
Oh, Lordy, were they ever. I mean, I'm looking at it, and now I look at the turnaround this morning, and I'm saying this is starting to feel like 2009 all over again. 767 points down on the Dow yesterday. Every single stock on the Dow was off. And what really is scary is the Dow was the best faring of the three indexes because NASDAQ was down almost 3.5%. Standard & Poor's was down almost 3% yesterday. Boy, you want to see a sellout, just get into a spitting match with China on trade, right?
Exactly, Dave. And you know what it really did for, I don't know if it really did for us, but where it really put us was if you look at 12 months ago, where were the markets? And at this point, the Dow is now up 1% from where it was 12 months ago. The S&P 500 is up less than 0.2% from where it was 12 months ago. And the NASDAQ is actually negative 1.1% from a year ago.
Wowzers. I mean, people look at the year-to-date numbers and say, oh, wow, it's pretty good still. But you got to keep in mind that January 1st of this year was right in the middle of a correction. And when you go back 12 full months, that kind of is the tail of the tape, isn't it?
It really is, you know. And we had been pretty much gaining some momentum there and getting some green ink, but yesterday was pretty much a wipeout day.
Boy, was it ever. It was interesting. Like I said, every single stock on the Dow declined. I was saying before we went on the air, I went to bed last night before 9, like I usually do, and I checked my cell phone to see what was going on, and the Dow futures were off another 500 points, and I was saying, holy crud. It was right about then that China blinked. They pegged the yuan to a number just below that psychological 7 to $1 number that has everybody getting a case of the jitters. And holding the yuan at one number was enough to really turn the mood on the stock traders. If anybody had any doubt that the trade war with China was driving the market, the turnaround that happened about 9 o'clock last night would probably illustrate that, yep, that's what's doing it, right?
Well, absolutely. You know, and it's the uncertainty. You know, there was the uncertainty of where is China going to peg this currency. And so the unknown, there is one thing that the markets do not like at all, and it's uncertainty. And so by them pegging it, even if it wasn't where we wanted to get pegged, it was at least brought some certainty to the markets in terms of where China was going to be at.
And, you know, once again, it illustrates the point that we've been making down the line. China definitely blinked in this latest standoff here. And it just kind of underscores that down the line, we have the potential of causing more damage to China's economy than they do to us. And that's kind of a scary thought, given what happened to our economy yesterday.
Well, it did, and it really wasn't our economy, Dave. It was just the markets as a whole. And so, the one thing that I bring about that whole thing is that you're right. We can hurt them a lot worse than they can hurt us. However, they have mechanisms in place to protect their people probably longer than what we would be able to protect our people from feeling the brunt of it.
Well, among other things, it's called the Army.
Well, that and just like they're moving their currency now, and they'll come in and buy stuff, and they'll come in and do things like that to help their economy along.
Understood. Yeah, the command and control economy in China, it's the same thing we talk about when we talk about their growth rates down the line. If they say they're only growing by 5%, you wonder what the real number is, because everything that comes out of China is controlled by the government. And point well taken, they can do more things in order to protect their citizenry from finding out just how crummy things are. But still, that having been said, the fact that they blinked that fast in this currency war kind of indicates at the very least that we're putting a world of hurt on them with this tariff war, for good or for ill. At the very least, we're doing the damage on their side of the fence. It's prompting them to insulate their citizenry.
Well, you're right, David. But I think the other thing we look at is, hey, they're sitting down at the table again next month, and so they've. I think they're all got to proposition themselves to a position of, okay, we're going to come back to the table. We need to. We don't want to get so bad that we don't even look each other across the table.
Exactly. You don't want to get to the point where we're treating China like Iran and we don't even speak to them. Just to give an idea of just how bad things were yesterday on U.S. markets, the only place you could have made any money yesterday was if you were investing in the VIX, the instability index, for lack of a better term for it. It was up like 38% yesterday. And I was looking at our bonds and interest rates. The 10-year Treasury bill dropped another 12 basis points yesterday. 10-year Treasury notes are now looking at 1.76% interest, and, well, 1.75. It just went down again. I'd never dreamed I'd see a rate that low on the 10-year bills.
Well, that's true at this point. But you remember now where we were a couple of years ago, Dave. We were floating down below 1.5 and 1.6. So we're still up from where we were in the mass crisis mode. But you and I both agree interest rates should be much higher than what they are today. And that's really, just because they're going down is not necessarily a good sign for our economy.
Understood. Generally, it implies a flight to safety for the serious investors that just want to get their money someplace where they know they're not going to lose their shirt for the moment. We do have some reports coming out as earnings season continues on what is doubtless going to be one of the more volatile weeks we've had for a couple of years. Any indications that our American companies are doing okay?
We've got kind of a mixed boat right now. We've got Allergan coming out, the drug maker. They're the big maker of like Botox. And so people must still be buying it crazy because they beat by about 3 cents a share, had a great profit, $4.38 a share. Revenue topped the forecast. They even raised their full year guidance, which is always a good sign. They're not getting helped a whole lot this morning with the markets, though. They're only up about 0.25% this morning before we get started.
All right. I don't see them on my big winner and loser list, so I wasn't looking for an exciting move in one direction or the other.
So let's talk about Dean Foods as far as a big loser. And it may not show up on your end there because it's such a low price stock anyway. But Dean Foods is a big milk producer. They lost 36 cents a share. That was a lot wider than the 13 cents they were expected to lose. Revenue missed. They're complaining about dairy commodity inflation, volume pressure. And here's one thing I thought was interesting is, and now that I think about it, it's true, people are moving away from white milk. And so that's a big factor for them. But they're trading down 31% this morning. Now,
wow.
Yeah, they closed yesterday at $1.67 a share. Right now they're at $1.15. So
and they're rapidly approaching the $1 number where the stock exchanges start saying, "Do something faster, we're delisting you."
Yeah. Now they're 50. If I look at their 52-week high, 52-week low, it's amazing. Their range was that I'm sorry, 87 cents to $9.75. They're approaching that 52-week low.
And that kind of a range almost never happens in almost any stock without some sort of a disaster going on in the company. And from what at least the report is saying, Dean Foods is just suffering from the ups and downs of the market of their the market of their primary products.
Yeah, I think it's the business they're in. As a whole, that industry is just suffering.
I
Um,
understood.
on the other side, we got Energizer, the battery company.
Yeah.
They beat by about. I'm sorry, they didn't beat. They missed by about 9 cents a share. Revenue missed also. Their battery division did okay, and I didn't realize this. They're in the auto care product business, and that area kind of missed. Um, but they were negative when I first looked. They're back up. They're up 1% right now, from where it was a few minutes ago.
Evidently, their core business saved them with the investors.
I think so. I think so. The battery business is important. Hey, we're in hurricane season, and let's face it, you need batteries right now. That's for sure.
Yeah.
So I've got Mosaic, the fertilizer producer. They're probably one of the larger producers of fertilizer out there. They came in at 12 cents a share, which was well short of what was expected. They're expected to come in at 29 cents a share. Revenue missed. And they're blaming it on weather out in the Midwest. All the rain they've gotten has hurt their spring fertilizer season. And so that was a big downturn for them. They're down about 4.25% this morning.
I'm going to bet next quarter that we're probably going to hear they had some difficulties in their mining operations around here with all the rain we're getting here as well.
Exactly. Rain it can affect them in several different ways.
The phosphate operations make them one of the bigger employers in this part of the state, and it hasn't exactly been good mining weather for the last few weeks.
No, you're right. It hasn't been at all. I got just a couple more. I got Shake Shack. We don't have any around here, but they beat by 4 cents a share. Revenue was top forecast. And, one of their key metrics is how did their same restaurant sales go? And they beat pretty well. They're up 3.6% compared to the 2% that was expected. And they're trading up 2% from where they closed yesterday. Marriott, we look at a couple of travel companies. Marriott came in as expected at $1.56 a share. Revenue did miss. And one of their big things, they cut one of their key forecasts, their revenue per available room. They're blaming it on weakening business travel. So I find that kind of interesting when we start to look at our economy. If we're talking about the business travelers starting to slack off, then that's just one of those indicators that maybe things are slowing down in the business world. And they're down about 1.8% after being down 4% yesterday, Dave.
Interesting. I wonder if that's tax related or really economics related, because a lot of travel decisions based upon the changes in income tax forms and income tax deductibility kind of has changed this year as far as employee business expenses. I wonder if that made a difference too.
Well, it could have, but I would think business travel in terms of corporate and business would have affected it. But you're right. The salesman who's trying to write off his expenses as a W-2 employee, he got hurt this last year. He can't deduct those anymore. So you're right from that standpoint. Hey, I got one more on the travel side.
All right.
Budget. They beat by 5 cents a share. Their revenue was a little bit below what was forecast. They've been able to reduce some of their expenses, and they're down about 2% right now, which is better than what it was a little earlier. So they seem to be bouncing back right now.
All right. There's a little bit of a rising tide floating all boats this morning as it goes, setting the table this morning. Yesterday was, like we said, a disaster. Dow was down 2.9%, 767 points. NASDAQ down 278. S&P down 87, and it looked even greasier last night until China blinked with their policy on currency. 45 minutes before we start trading this morning. There was a turnaround overnight. Phillip, how much of yesterday are we going to get back today?
Well, we're going to get some of it back, at least at the open. I wouldn't hold my breath for how much yet, but we are getting a bump up. Everything's pretty much green across the board. We've got the Dow up about almost 0.9%, $219. The S&P 500 is right there with them, but almost up 0.9%, $25. NASDAQ, the biggest gainer right now, up just a tad over 1%, of $76.50. Gold and silver are basically flat right now, and we've got crude oil sliding up 0.25% to $54.84 a barrel right now.
All righty. And overseas markets, by and large, the Asian markets were unimpressed with China blinking because they're both off this morning that I've got here. And the European markets are turning the corner and heading upward along with our futures at the midway point in their trading day. Phillip, if there ever was a time for an investor to say, how do I stabilize my retirement, this would sound like about the right time. How do I find you for some advice?
Absolutely, Dave. Now's the time to get the must-have financial x-ray analysis of your current portfolio to determine where you are. You must know where you are so you know where you need to get to. And so that's what this report really does for you. Call us at 382-0037 to schedule your appointment. Again, we saw a lot of volatility yesterday. We've got our free report on understanding market corrections. All you have to do for that one is text the word market to 863-285-3815, and then join us every weekend, Dave, for the Statler Financial Radio Show, 6 a.m. and noon on Saturdays, 10 a.m. Sunday mornings, right here on News Talk 730 a.m.
All righty. Streaming as well at newstalk730am.com. Phillip, thank you much. We'll catch you on tomorrow. Fair enough?
All right, buddy. Thanks. Have a great day.
You too, my friend. It's 105.7 Light FM and Statler Financial Services, Phillip Statler.
Hey, folks, again, I want to thank you for joining us today. I hope that you found this valuable and that you got something out of it. When we talk about the economy and the big picture, it's a little bit more information than what you get out there on the street, some interpretation. But I hope you enjoy it. Like our page here on Facebook. Share this video with your friends and neighbors. Like us. We'd really appreciate it. Have a great day. I look forward to speaking to you again tomorrow.